The market opted to sell the US dollar in the aftermath of the Fed decision. The Fed delivered on the widely anticipated part of the risk with the first rate hike in 2018. And while there was plenty of room for hawkish interpretation, the initial reaction was to the dovish side, with the market almost looking to see as it wanted to see it, focusing on the tweak in the language to moderate growth from solid growth and on the unchanged 2018 forecast for 3 rate hikes. And yet, despite a recent cooling on the inflation front, the Fed did nothing to change its outlook for higher inflation, while at the same time the Fed went ahead and upgraded growth forecasts and increased rate hikes going out beyond 2018. All of this, of course, still leaves the door open for 4 hikes in 2018. So on net, the reaction seemed to be questionable, with the market wanting to move things the way it did on the hope that everything would keep with the Goldilocks recovery story where investors could have their cake and eat it too. But we would highlight a major fundamental shift in the trajectory of Fed policy and market expectations that needs to be recognized to understand that what is dovish today would have been super hawkish in the past. Right up until 2017, the conversation was about the Fed delivering less than what it had promised. And yet now the conversation is about whether or not the Fed will deliver more than what it has promised. That's a big deal in our view. So whereas in 2017, the conversation was about 2 hikes instead of the 3 promised, in 2018, it's about 3 hikes instead of what could be 4. And so we believe the dollar was probably hit harder than it should have been if we are to consider the FOMC risk alone, and would be looking for a move back in the buck's favor over the coming sessions. Interestingly, the stock market confirms this bias, with equities not able to do anything with the dovishness reflected in the currency market, something we have not seen in recent years. Of course, we have been careful to stress this analysis is exclusive to the Fed decision, as the bearish dollar driver of U.S. protectionism and soft dollar policy is not one to be taken lightly. The president is now expected to announce sanctions against China later today, reportedly after the U.S. market close, and this could shake things up some more. What's difficult with all of this is that, as it relates to the dollar, it's the fact that U.S. protectionism is U.S. dollar bearish on the surface, but at the same time, if risk sentiment deteriorates because of this protectionism, it could inspire a massive flight to safety bid that will translate into dollar inflows. This is the added wrench or riddle that sits in front of many currency traders at the moment, and it will be interesting to see how it all plays out. But one thing should be clear here. As much as there has been a whole lot of giving up on the dollar over the past several months, it would be silly to discount the possibility of another big run in the buck. Moving on, the market will need to be focusing on another big event risk today with the Bank of England policy decision on tap. It seems the recently announced transition deal and Wednesday's stronger earnings have been helping to fuel expectations the BOE will deliver a more hawkish message, with possible references to a hike as soon as May or August. This week's inflation readings were, however, soft, and it's also important to remember that even with a transition deal in place, there is nothing binding and still plenty of issues that need to get worked out. Throw in a very strong move up in the pound that has cooled off inflationary pressures, and it's quite possible that hawkish expectations could be let down. Earlier today, the RBNZ left rates on hold in a non-event decision, while Aussie jobs data came in mixed. Looking ahead, aside from the BOE decision, other standouts on the calendar include manufacturing PMIs out of Germany and the Eurozone, German IFO readings, and U.S. initial jobless claims. That's all for now.